Welcome to the virtual classroom, where this time we'll be looking at the second half of adjusting entries. In the last adjusting entries video, we saw prepaids and unearns, where cash had already happened and now we needed to make an adjusting entry to show that we had earned that revenue or that we had received the benefit of the expense. Now it's time to look at the next set of adjusting entries, specifically accrued expenses and accrued revenues. With these items, cash has not happened at all. We're in fact waiting for cash to happen. So the first one is an accrued expense. With an accrued expense, it is an expense that has not been paid, has not been recorded, but we have received the benefit of it. But we haven't done the journal entry. So essentially, we'll be doing the journal entry to show that we've received the benefit of something. Now, remember, adjusting entries never include cash. So as we look at our example, let's look at it closely. On December 31st, Cool Kicks receives a bill for utilities in the amount of $500 used during the month of December. The bill will be paid on January 2nd. So notice cash has not happened. Prepare the entry to record the unpaid utility bill. So in this one, we are not doing the entry for January 2nd. We're doing the entry for December 31st. As of December 31st, we received the benefit of the utilities, but we haven't paid the cash, which means we owe someone some money. So what we'll see is a debit to utilities expense and a credit to utilities payable. So typically, when you're looking at an accrued revenue, we debit the expense, we credit the payable. Let's look at another example of an accrued expense. I think I said accrued revenue a few seconds ago, and it's supposed to be an accrued expense. So as of December 31st, Cool Kicks employees have earned $1,000 in salaries that will be paid on the next payday on January 2nd. Prepare the adjusting entry to record the unpaid salaries. So again, this is an accrued expense. We have earned the benefit of those employees working. Yes, they earned their pay, but we got the benefit of them working, but we haven't paid them their money yet. So that actual payment, the cash payment, will happen on January 2nd, but we owe them the money today. So when we do the entry, we'll see a debit to the expense and a credit to the payable. We're just changing the adjective. And I have typos all over the place. I spelled payable wrong here, and I put an extra word for here. Ignore the typos and the errors. We still debit the expense and credit the payable. So with accrued expenses, things to remember. An accrued expense is an expense that has not been paid, has not been recorded, but we receive the benefit of that expense. So we have to record the fact that we received that benefit and the fact that we owe someone. So we debit the expense and we credit the payable. Next, let's look at an accrued revenue. With an accrued revenue, this time we've earned the money, we've provided the service, we've delivered the goods, we've done our part, but we haven't received the cash payment. So, knowing that we haven't received the cash payment, hopefully you can guess that this one involved a receivable and a revenue. So, in this example, as of December 31st, Cool Kicks has an investment account with the bank that earns $100 in interest. That earned $100 in interest. The interest will be credited to the company's account on January 1st. Prepare the adjusting entry to record the interest that has been earned but not paid as of December 31st. Now, if we earned it in December, we have to make sure we get that expense in December. It was the same thing back here in dealing with the utilities. We received the benefit of those utilities in December. We received the benefit of those employees working in December. So we have to make sure the expense gets in December. We need to make sure the expenses are matched with the revenues. On this side, we need to make sure that the revenue is recorded in the proper period. I don't want to record the revenue in January when I actually earned it in December. So in the accrued revenue adjusting entry, we debit some type of receivable and we credit some type of revenue. Notice we're just changing the adjective here. We debit interest receivable, we credit interest revenue. So things to remember when it comes to accrued revenue, it involves revenue that we've earned, but we haven't received it yet. So keep in mind, we debit that receivable and credit the revenue. After we do our adjusting entries, we need to post again. If you need a refresher on posting, go back and look at one of the previous videos where I show you how to post, but the process is the same. We're transferring the information from the journal to the ledger so that we can create our adjusted trial balance. This is the second trial balance that we create throughout the accounting cycle. We actually do 3 in total in terms of trial balances, so stay tuned for that third trial balance. Right now, for the adjusted trial balance, notice that cash didn't change. Why? Well, cash is never a part of an adjusting entry. But some of my other accounts here changed. I see interest receivable, and we should have some interest revenue down here. Notice that supplies changed. Remember from the previous video, we messed with our supplies. We have accumulated depreciation added here. So all of the adjusting entries that we did, you're going to see those reflected on the adjusted trial balance. So that takes care of our adjusting entry videos. Thank you so much for watching these videos. If you have any questions, please comment in the comments, drop a like or subscribe to the channel where I will be updating with more videos in the future. I certainly appreciate your time and attention, and I hope you have a wonderful day.